stocks, bonds, mutual funds, ETFs. You hear these buzzwords on the financial news every single day, but if someone asked you to explain exactly what they are, could you do it? Wall Street relies on your confusion to sell you expensive, wealth-draining products. By the end of this 20-minute video, you will understand exactly what these four assets mean, how they mathematically generate wealth, and which one is the safest place for your money. Before we define the actual assets, we must address the massive psychological barrier that prevents 95% of the population from ever building true wealth. The confusion you feel when you open a brokerage app is not an accident. It is a highly engineered smokescreen. The financial services industry is a multi-trillion-dollar machine. Their entire business model relies on you believing that managing money is far too complicated for an everyday person to understand. If they can convince you that investing is terrifying, you will surrender your power and hire an expensive financial advisor. That advisor will then siphon off 25% of your life savings over 30 years in the form of management fees. Today, we take your power back. When you strip away the complex math, the flashing red screens, and the screaming television anchors, the entire global financial system boils down to exactly two fundamental concepts: owning and loaning. There is no secret third option. You can either legally own a piece of a business, which is called equity, or you can legally loan your physical cash to a business, which is called debt. Every single buzzword you have ever heard is simply a variation, a combination, or a package of those two basic actions. Once you grasp this simple truth, the Wall Street matrix completely shatters. Let us break down the absolute undisputed king of wealth creation, the stock. The first and most famous asset class on earth is the stock. You will also hear it called a share or equity. These words all mean the exact same thing. The biggest psychological mistake beginners make is viewing a stock as a digital lottery ticket. They think it is just a blinking three-letter symbol on a computer screen that magically fluctuates based on pure luck. This is completely false. A stock is a legal, physical reality. Look at the diagram on this slide. Imagine a massive, incredibly successful technology company. When this company wants to build 50 new factories around the world or invent a revolutionary new microchip, they need billions of dollars in raw cash. Instead of borrowing that money from a massive bank and paying terrible interest rates, they go to the public. They take their entire corporation and they slice it up into millions of tiny, perfectly equal fractional pieces. These pieces are called shares of stock. When you log into your brokerage account and buy one share of a company for $200, you are executing a legally binding contract. You literally become a fractional owner of that corporation. You own a microscopic percentage of their massive glass headquarters, their brilliant software engineers, their patents, and every single product they sell for the rest of eternity. Because you are an owner, you make money in two ways. First, capital appreciation. If the company doubles in size over 10 years, the physical value of your slice doubles. Second, dividends. Many mature companies take their excess cash at the end of the year and deposit it directly into your bank account, simply to thank you for being an owner. Stocks are the high-octane engine of your portfolio, capable of massive growth but highly volatile. If stocks represent owning, then the second core asset class represents lending. We now arrive at asset number 2, the bond, also known in the financial industry as fixed income. With a stock, you take on the massive risk of being a business partner. But with a bond, you flip the script entirely. You literally become the bank. Let's go back to our massive corporation. If they do not want to slice up their company and sell ownership shares, they can issue a bond. Or if the United States government needs to borrow money to build highways and military jets, they issue a treasury bond. A bond is simply a formalized, legally binding IOU. Here is exactly how it works. You look at the government, and you loan them $10,000 of your physical cash. In exchange for your money, they hand you a bond contract. This contract states two non-negotiable guarantees. First, they guarantee to pay you a strict fixed interest rate every single year for the life of the loan. Let's say it is 4%. They will pay you $400 a year, every year, no matter what happens to the economy. Second, the contract has a maturity date. Let's say the loan is for 10 years. At the exact end of those 10 years, they are legally obligated to hand you back your original $10,000 in full. This makes bonds the ultimate financial shock absorbers. They are incredibly safe, highly predictable, and completely boring. If the stock market crashes by 30% tomorrow, your bond does not care. It continues to pay you your 4% interest like clockwork. However, because the risk is so incredibly low, the reward is strictly capped. Bonds will keep you rich, and they will protect your money during a recession, but they will never make you a multi-millionaire from scratch. To truly understand the profound difference between these two assets, you have to look at what happens in the absolute worst-case scenario. Corporate bankruptcy. Imagine a massive, publicly traded company completely fails. They run out of money, they close their doors, and they declare Chapter 11 bankruptcy. There are only a few $1 million left in the company's bank accounts, but there are thousands of angry investors demanding their money back. Who legally gets paid first? This is determined by the legal capital structure. And the rules are brutal. As you can see on the breakdown on your screen, the bondholders, the lenders, are at the absolute top of the legal food chain. Federal bankruptcy courts dictate that the people who loan the company money must be compensated first. The courts will literally force the failed company to sell their office chairs, their computers, and their physical real estate, just to gather enough cash to pay the bondholders back. But what about the stockholders? The people who bought shares? Stockholders are the owners, and as an owner, you absorb the ultimate liability. Stockholders are placed at the absolute bottom of the food chain. By the time the bondholders, the lawyers, and the tax agencies take their cut of the remaining cash, there is almost never a single penny left. The stock price plummets to zero and the owners lose everything. This extreme risk profile is exactly why stocks historically offer vastly higher returns than bonds. You are demanding to be compensated for taking on the maximum possible risk. This dynamic is exactly why you can never rely on just one single stock or one single bond to secure your future. Now you know what stocks and bonds are. But if you log into an app today, take your entire life savings and buy stock in one single company, you are making a fatal, catastrophic mistake. The biggest risk in the financial world is called the single point of failure. Amateurs try to guess the future. They fall in love with one specific electric car company or one specific social media app, and they dump 100% of their net worth into that single stock. This is not investing, this is gambling. History is an absolute graveyard of massive, invincible corporations that completely vanished from the earth. Blockbuster Video dominated the globe until streaming technology rendered them completely obsolete overnight. Enron was one of the largest energy companies on the planet until the executives were caught committing massive accounting fraud, and the stock price went to absolute zero in a matter of weeks. If you put $100,000 into one single stock and that company files for bankruptcy, your money is completely vaporized. It is gone forever. You are betting your entire financial future on the decisions of one CEO. To survive and build permanent wealth, you must completely eliminate the single point of failure. You must diversify. You must spread your money across hundreds or even thousands of different companies simultaneously. But buying 500 different stocks manually would take hours and cost a fortune in transaction fees. This mathematical problem brings us directly to asset number 3. Decades ago, Wall Street recognized the massive danger of buying single stocks. They knew everyday people couldn't afford to manually buy one share of 500 different companies to stay safe. So they invented a solution. We now arrive at the third asset class, the mutual fund. If a single stock is a single apple, a mutual fund is a massive grocery basket filled with hundreds of different apples, oranges, and bananas. Here is exactly how it works. You and thousands of other investors pool your physical cash together into one giant mountain of money. A highly paid human being called a fund manager takes that massive pool of cash and uses it to buy a highly diversified basket containing hundreds of different stocks and bonds. When you invest in the mutual fund, you are buying one share of the basket itself. Instantly, with one single transaction, your money is spread across 500 different companies. You have achieved total perfect diversification. If one single technology company inside the basket goes bankrupt, your portfolio doesn't collapse. You barely even notice because the other 499 profitable companies in the basket completely absorb the shock and effortlessly carry the weight. The mutual fund completely solved the single point of failure. It allowed everyday middle-class workers to invest safely. However, because this was an old legacy system that required a physical human being in a suit to actively manage the basket, pick the stocks, and process the transactions, it introduced a highly toxic, silent wealth killer into the equation. The vast majority of traditional mutual funds use what is called active management. This means there is a team of highly paid analysts sitting in a skyscraper in New York, actively trading stocks inside the basket, desperately trying to guess the future and beat the market average. Because these managers demand multi-million-dollar salaries, the mutual fund has to pay them. How do they pay them? By silently skimming money directly out of your retirement account every single year. This hidden fee is called the expense ratio. Many traditional mutual funds charge an expense ratio of 1% or even 1.5%. To an amateur investor, 1.5% sounds completely harmless. You think, sure, I'll pay 1.5% for a Wall Street expert to handle my money. Look at the devastating math on this slide. This is a catastrophic misunderstanding of compound interest, because that fee compounds against you year after year over a 30-year timeline. A 1.5% fee will literally drain roughly 30% of your total life savings and hand it directly to Wall Street. If your account was destined to reach $1 million, the Wall Street manager just silently stole $300,000 of your family's wealth. And here is the ultimate insult. Decades of undeniable peer-reviewed financial data prove that 90% of these highly paid active mutual fund managers completely fail to beat the basic market average over a 15-year period. You are literally paying hundreds of thousands of dollars in fees for a human being to underperform a simple computer algorithm. The industry needed a better, cheaper system. The massive frustration with high fees and clunky mutual funds led to the invention of the fourth and final asset class. This is the absolute undisputed champion of modern investing. It is the ultimate cheat code for the middle class. The ETF stands for Exchange Traded Fund. An ETF takes the absolute best part of a mutual fund, the massive, beautifully diversified basket of hundreds of stocks, and it completely strips away the toxic Wall Street middleman. Instead of hiring a guy in a suit to actively pick stocks, most ETFs use passive automation. They simply use a computer algorithm to track a specific list of companies. For example, an S&P 500 ETF simply programs the computer to automatically buy the 500 largest monopolies in America. If a company fails, the robot kicks it out. If a company succeeds, the robot adds it. Because a computer is doing all the work, the fees absolutely plummet. While a mutual fund charges 1.5%, a premium ETF charges a microscopic 0.03%. You keep almost 100% of your compound growth. You successfully eliminated the middleman. But the real magic is in the name: exchange traded. Traditional mutual funds are clunky. You can only buy or sell a mutual fund once a day after the stock market closes at 4 p.m. But an ETF trades on the open stock exchange exactly like a single share of Apple. If it is 10:15 in the morning and you want to buy an ETF, you click a button and it executes instantly. It gives you the massive, robust safety of a diversified basket, combined with the lightning-fast liquidity of a single stock, all at the lowest possible price. To ensure you never get trapped by a smooth-talking financial advisor, let us put these two baskets head-to-head. Look closely at the comparison matrix on your screen. First, consider how they trade. When you buy or sell an ETF, it trades in real time, exactly like a single stock. If the market is open at noon and you click buy, you lock in the exact price at that specific second. A mutual fund is a slow dinosaur. No matter what time of day you click buy or sell, the transaction will not actually process until the market completely closes at 4 p.m. You are stuck waiting in the dark. Second, consider taxes. Mutual funds are terribly tax inefficient because the human manager is actively buying and selling stocks inside the basket all year long. They are constantly triggering capital gains taxes. Even if you never sold your share of the mutual fund, you will receive a tax bill at the end of the year because of what the manager did. ETFs have a unique legal structure that prevents this internal tax bleed almost entirely. You only pay taxes when you personally decide to sell your ETF share, but the final nail in the coffin is the fees. As we discussed, a mutual fund fee can easily eat 25% of your total lifetime compound growth. The ETF charges practically zero. The verdict is absolute. While mutual funds inside a corporate 401k are fine because you are forced to use them, if you are investing your own money in an IRA or a standard brokerage account, the ETF is mathematically, structurally, and logistically superior in every single category. Now, you hold the keys to the kingdom. You know the definitions of all four assets. The final step is execution. How do you actually mix these pillars together to build a bulletproof portfolio? You do not buy individual stocks, and you do not buy individual bonds. You buy ETFs that hold them. You buy a stock ETF for growth and a bond ETF for safety. The exact percentage of each depends entirely on your age. This is called asset allocation. Look at the master blueprint on the screen. If you are in your 20s, 30s, or 40s, you are in the wealth accumulation phase. You have decades of time before you need to touch this money. Time is the ultimate neutralizer of risk. Therefore, you do not need the safety of bonds right now. Your portfolio should be incredibly aggressive. 90 to 100% invested in broad market, low-cost stock ETFs, like an S&P 500 ETF. You want maximum exposure to the extreme, compounding growth of corporate stocks. When the market crashes, you don't panic. You just buy more ETFs at a massive discount. But as you cross into your 50s and approach the age of 65, the strategy completely flips. You enter the wealth preservation phase. If you are retiring next year, a 30% stock market crash would literally destroy your ability to buy groceries. You no longer have 10 years to wait for the market to recover. So you begin selling some of your aggressive stock ETFs, and you use that cash to buy bond ETFs. You transition your portfolio to a mix, perhaps 60% stocks and 40% bonds. You intentionally sacrifice a little bit of future growth to build a massive ironclad shock absorber. The bonds guarantee your income, allowing you to sleep perfectly soundly at night regardless of what the economy is doing. The financial industry spends billions of dollars every year on marketing campaigns designed to make you feel completely uneducated. They want you to believe that the stock market is a hyper-complex, mystical entity that only men in expensive suits can navigate. They do this so you will hand over your money and allow them to drain it with massive mutual fund expense ratios. Today, that illusion is completely shattered. You now possess the exact translation. You know that when you buy a stock, you are legally buying a slice of a physical, highly profitable business. You know that bonds are just contracts where you act as the bank to generate extreme safety. You understand that picking single stocks is a catastrophic risk, and that old-school mutual funds are just massive baskets carrying expensive, unnecessary human managers. Most importantly, you understand the modern cheat code, the ETF. By simply logging into a brokerage account, buying a low-cost S&P 500 index ETF, and automating a monthly deposit, you are flawlessly executing a strategy that will mathematically outperform 90% of highly paid Wall Street hedge fund managers over the next 30 years. You do not need a degree in advanced mathematics to become a multimillionaire. You just need patience, consistency, and a fundamental understanding of the assets you are holding. Wall Street's greatest weapon was your confusion. You have taken that weapon away. Open your account, buy the ETF, ignore the daily news panics, and let the relentless upward trajectory of human progress build your generational wealth.